And good morning again. So this is our Wednesday class. On Monday, we talked about bonds and bond pricing. Not much actually, but the prices of bonds and how they are related to interest rates. That was the big deal. And towards the end of the lecture, we ended at the point where we said interest rates are measured in money, but we care about the purchasing power. So we differentiate between real and nominal interest rates. So let's pick up there, all right? We think of nominal interest rates. These are the monetary interest rates, right? So when you pay 800 liras for a bond that pays off in a year and it pays off 1,000 liras, your interest is 200 liras. Fine. The interest rate is 25%. Fine. But what has happened to your purchasing power? You gave up 800 liras worth of current purchasing power to get 1,000 liras worth of future purchasing power. But the prices also changed in between. So what happens there? Okay. The answer to that is the real interest rate, right? And the relationship, as we thought then, is 1 plus the nominal interest rate, okay, is 1 plus the real interest rate times 1 plus the inflation rate, okay? So this is a relationship that holds in gross terms. You could think of this, it's correct that this is the total nominal payment you get, right? Principal plus interest. This is the total real return you get, principal plus real interest. And this is what is happening to the price level, right? Because this was the initial price level and it increased by the inflation rate, all right? Once again, a Taylor series approximation gives you for small I, R, and pi. So when these things are close to zero, because we approximate around zero, and the approximation is correct when the numbers are close to zero, we have I is about equal to R plus pi. Right? Now, we left here and said we could think of this in two ways. The ex ante interest rate and the ex post interest rate. The difference is when we are thinking of this question. So I could ask, what is the interest rate at the time I'm making the loan, I'm buying the bond? And I could ask, what is the interest rate at the time when I'm being paid off at maturity? Vadesinde, right? Ex ante is before the event. Ex post is after the event. Event, once again, is the realization of inflation. That's the thing we don't know, okay? Now, it has to be clear to you. Let's say we enter a lending borrowing agreement, which implies a 10% interest, all right? So the nominal interest rate is 10%. Here is an easy question. What is the ex ante nominal interest rate? This is really a question of whether you're really there or not. That's right. Yeah, it is 10%, okay? What is the ex post nominal interest rate? At the time I'm paying off, what interest do I pay you? That's the wrong answer. Yeah, the nominal interest rate, the ex post nominal interest rate, it's again 10. That's right. That's right. It's again 10. Okay? Because the nominal interest rate is the money that I'm going to pay you as interest. The money is the same regardless of what happens to inflation. Kaan Bey, is that good? The nominal interest rate is if we're buying and selling a bond, right? You buy bond at 800 liras, knowing that you're going to get 1,000 liras at the end of the year, okay? So you're going to get 20% interest. Ex ante is 20% interest. Ex post, when I pay you, I do pay you 1,000 liras. You get 200 liras of interest. And it's again, damn it, it's not of course 20 is 2. 25%. Ex ante it was 25%. Ex post is again 25%. Okay? The monetary amount itself doesn't change with inflation. So ex ante and ex post are the same. Kaan, is that good? Are we all right? Very good. Mohammed? Very good. All right. So the point here is from the perspective of the nominal interest rate in a standard debt contract, when you are buying a bond or when you're going into a bank loan, where the bank says, okay, here's $1 million for you to do your investment. At the end of the period, you're going to pay us 1,100,000 liras, right? You see that, okay, I'm paying 10% interest. And at the end of the period, when you pay, you are paying 10% interest, okay? So the nominal interest rate is always the same. But the real interest rate changes, okay? Ex ante, we do not know the real interest rate. We have an expected real interest rate based on expected inflation, right? Good. Once again, I see the same people responding via chat, and I'll really appreciate if more of you chime in so that I know that you're there and you're following, right? That's the whole purpose of having the class. So what happens? We think that inflation is going to be 8%. We enter into a debt contract that implies a 10% interest, okay? Now the question then becomes, what is the ex ante real interest rate? How much more purchasing power, let's say I'm the borrower, okay? How much more purchasing power do I expect to transfer at the end of the borrowing period? 10% nominal interest rate, 8% inflation. But this inflation hasn't been realized yet. 8% expected inflation. Ex ante, what is my expected real interest rate? You? That's right. Yes. Okay, you figured it out. Yes. It's already here anyway, right? So if this is 10%, this is 8%, this is 2%, right? So you expect ex ante, you expected to pay 2% real interest. Fine. This is really the answer to the question, okay, so I borrowed the right to buy 100 potatoes, okay, in money. When I'm paying back in money, how many potatoes worth of purchasing power do I expect to transfer to my lender? Okay. Here the answer was I expect to give 102 potatoes worth of purchasing power. Okay. So that's 2% real interest. Fine. Now let's say at the end of the year, inflation actually turns out to be 8%. Okay. What is the ex post real interest? This is no longer expected, right? It has been realized. We know inflation and we know the real interest we are actually paying. What is the ex post real interest rate? Yeah, it's the real interest is 2%, okay? Yeah. Nominal interest rate ex post is 10, real interest rate ex post is 2. Now let's think that our expectations weren't exactly correct. Inflation turned out to be, let's say, 3%, okay? Inflation turned out to be much lower than we thought. What is the real interest rate now? It is 7%, yes. But then, let me ask you this. As the borrower, am I happy that inflation turned out to be lower than I expected? For the purpose of this bank loan? No, I am not, right? Because I thought, when I agreed to give you 10% more interest, I thought I would be giving you 2% purchasing power. That is what really mattered. That is what really mattered to me, okay? When inflation turned out to be lower than expected, the purchasing power I'm transferring to you as interest goes up. The same money now represents a higher purchasing power than I anticipated when I borrowed from you, okay? So unexpected low inflation is hurting the borrower and obviously helping the lender, right? Because the lender, okay, now think of me as the lender. I lent to you I know that I'm going to get, 1,100,000 liras back. If inflation suddenly turns out to be lower than I expected, that 1,100,000 liras is actually a higher value in terms of goods and services. I am happy, okay? So unexpectedly low inflation is a transfer from lenders, from borrowers to lenders, okay? What if it's the other way around? How about this one? We enter a debt contract of 10% nominal interest, expecting 8% inflation, and inflation turns out to be, let's say, 12%, which could happen. If inflation is 12%, what is the ex-post real interest rate? Yeah, exactly, right? The ex-post real interest rate is minus 2%. Is it clear to you that the ex-post real interest rate can be negative easily? Yeah, all right, very good. Let me ask you a question. We talked about the ex-ante nominal interest rate not being negative, right? We said money already has an interest of 0 itself. I'm going to talk about exceptions to this in a few minutes. On the lender side, okay, where you know that inflation is going to be, or you expect that inflation is going to be 12%, and you're going to lend at 10% ex ante. Would you do that? We agree that expected inflation is 12%. Would you lend at 10%? Okay. Now, this is very nice, okay? You said no, and in general, actually, this is not a very correct answer. And a lot of places we see this, and this happens in Turkey routinely as well, okay? Because, in fact, it is the case now. The interest rates are sufficiently low and expected inflation is sufficiently high that the ex-ante real interest rate, is either 0 or somewhat negative. Here's why. Here's why this can happen. The same line of reasoning that we used to say, oh, you wouldn't lend at negative nominal rates does not apply to real rates for the following reason. Let's say, yes, exactly right. Can Tutuncu is exactly correct here. Okay, so the point here is this. If you don't lend and keep your 1,000 liras, okay, inflation is going to be 12% in expectation. So your 1,000 liras is going to lose 12% of its purchasing power over the year if you do not lend, okay? But I offer you 10% nominal interest. If you lend me, right, how much of your purchasing power will you lose at the end of the year? You're going to lose 2%. Which one do you prefer? Losing 12% or losing 2%? Exactly, right? So what happens here is, since money has a nominal interest rate of 0, okay, even if it implies a negative real interest rate, positive nominal interest rates at least protect you somehow, somewhat, from expected inflation, okay? So people can lend. Of course, you would hate to do this, but it's better than the alternative. Not lending incurs the whole cost of inflation. Lending at negative expected real rates at least protects you partway from inflation, all right? So this can happen, and it routinely does happen. When you're talking with proper monetary policy and cyclical monetary policy making, you're going to see that many central banks around the world push their real interest rates to negative territory so that people save less, spend more, borrow more, invest more during times of recession. And in fact, this is one of the problems of low inflation, too low inflation, or I'm sorry, on the side, I hear the doorbell ringing and it's distracting me. When inflation is too low, close to 0, or when we have deflation, the problem is, even if you bring the nominal interest rate all the way down to 0, right, real interest rates do not fall as much. Because if expected inflation is minus 1%, we have deflation, right? And I bring the nominal interest rate to 0, what is the expected real interest rate? It is 1. It is positive 1%, okay? But if inflation were, 3%, and I brought down the nominal interest rate to 0, what would the real interest rate be? It would be minus 3, okay? Which one makes you borrow and spend more? Obviously, a minus 3% expected real interest rate makes people more willing to, provides a stronger incentive to borrow and spend, all right? So expansionary monetary policy actually benefits from having some inflation. We learned this the hard way over the past decade after the global financial crisis, okay? Very good. So this is it for nominal and real interest rates, ex ante and ex post interest rates. Now we're going to turn to slightly fancier things, okay? One, just for your information, I spend my life thinking about these things and I would like for you to know it. To be clear, this is not exam material now, okay? The language I'm going to teach you, and I'm going to switch back to things that you should know. But when I asked at the beginning of the last lecture, what is bond in Turkish? And you said bono. And I was like, not exactly wrong, but not quite right. The reason was this. In the American terminology, okay, we classify these debt instruments by maturity. If maturity is less than 1 year, okay, so things between, borrowing 1 day to 1 year, these are called, and I think it includes 1 year, these are called treasury bills, okay? If the maturity is more than 1 year and including 10 years, okay, then these are called, my apologies, it's not bonds, these are called notes. And when the maturity is more than 10 years, these are called bonds. Now, the Turkish language, the Turkish terminology doesn't quite work this way. We don't have a three-way distinction. We have two, okay? The short-term stuff we call bono, okay? And the longer-term stuff we call tahvil. Birine hazine bonosu denir, birine devlet tahvili denir. Bunlar aslında aynı şeyler, vade bakımından farklılaşıyorlar. Dolayısıyla mesela işte hazine 8 aylık bir şey çıkartacaksa eğer, buna bakıp hazine bonosu çıkartıyor diyoruz. Eğer hazine 5 yıllık borçlanıyorsa o zaman devlet tahvili çıkartılıyor diyoruz. Now, we talked about the bond as being this one piece of paper that promises one future payment, okay? This is the part that you should know, and you're gonna get homework questions, quiz exam questions on these things. This kind of a bond that is just this one piece of paper, they're all one piece of paper or one electronic entity, but the thing that offers one future cash flow, okay? Today is the 25th, right? You buy this at a price that's going to be lower than 1,000, which is what gives you interest payments, okay? Thus, these things are known as discount bonds, right? Türkçesi ne? Can you guess? No. The particular, what is it in Turkish when we want to say it's a discount security? First, I see a question here. Nice, but no. Good try. Murat Bey, these are things that you're going to talk with Burçin Hoca. Yes, you are right. Okay, but we're not going to get there. When we talk about central banks lowering interest rates, we mean the interest rates in the interbank market. Yes. Bunun Türkçesi, discount bond in Turkish, Türkçesi iskontoludur. Tamam. İskontolu bono satın alıyoruz. The issue with this, when you learn more finance, those of your economists at least, you're going to understand that for various reasons, it's difficult to issue discount bonds at very long maturities. So if I tell you that, why don't you, let me sell you this thing, okay, this thing, but not for 2021, but for, let's say, 2040, okay, a 20-year bond. Or how about 2050? Turkey doesn't do this, but the US does. Many other countries do. The US does have a 30-year bond that is routinely sold, okay? So you're effectively being told, lend now, and you're going to see nothing for 30 years, okay? This doesn't sit well with people usually, okay? When you learn more finance, you're going to learn that this implies too long a duration. That's the problem, right? So the solution to this is to have bonds that make intermediate payments. So the way, in fact, bank accounts have this feature too sometimes. In Turkish, you would see things like 6 ayda bir faiz ödemeli işte 3 yıllık mevduat. Niye 6 ayda bir faiz ödemeli? 3 yıl oraya onu gömmüş olma. Arada bir sana da bir nakit akışı olacağını bil. So this happens when people desire to have intermediate cash flows. Okay, I understand that I'm going to get the 1,000 at the end of the year, but how about every year or every 6 months giving me a little bit something, $50, $100, whatever, okay? Can we do this? Can we structure a security of this sort? You're saying yes, and this is a categorical yes, actually. We can structure whatever we want, right? So those things, they come with something along the following. In fact, this was actually what they looked like when they existed. Okay, let's make this a 2-year security, 2022. Okay, for your information, in the US, this would actually look like this. It would have 4 coupons, not 5, but whatever. Get rid of this one. In the US, once the maturity is longer than 1 year, you're looking at what are called coupon bonds. Okay, in Turkey, we issue discount bonds up to 2 years, but this thing is a coupon bond. You know why? Because it has coupons. In the olden days, when these things were actually physical pieces of paper, right? It had these little coupons at the bottom that you clipped, took it to whoever issued it, and said, okay, this is the coupon for, and it would say something along the following lines. This is the, let's say, 5% coupon on 25/9/2020, okay? This is the 5% coupon for 25/3/2021, okay? And it would go on this way. The last coupon would be on the maturity date. So on the maturity date, you will get the principal and the coupon, okay? A security of this sort, we would say this is a biannual coupon. Biannual means twice a year, okay? It's a biannual coupon bond. This 5% is usually misleading because it says this is 5% per year. Thus, per 6 months, it pays 2.5%, all right? So for example, on this date, 25th of September 2020, when I clip this coupon and take it to the issuer, how much would I be paid? Do the math. Yes. Can I see a few more volunteers to do the math right? It's a 5% annual coupon on all, since there are 2 coupons per year, I get half of the payment on each one of them. So on each date, on each coupon date, I get paid 25 liras, all right? Now, what I want you to see here, and this is the key to thinking of this kind of coupon securities, think of this thing in itself, okay? Is this little piece of paper a fixed income instrument? Yes. So somebody wrote here, Dennis Bey, the first coupon actually pay more, assuming positive inflation. They don't pay more, but yes, they give you more purchasing power with positive inflation. That's exactly right. Okay? Yes. We could, and we do, issue index bonds. I could sell you this piece of paper with a little note on the bottom that says, on every cash flow date, I will multiply the cash flow with 1 minus 1 plus pi, starting from the issuance date. So I will pay you, I will compensate you for inflation. These are called inflation-protected securities or index-linked securities. Okay, and they exist. They exist in Turkey. They exist in the U.S. You know, the United Kingdom has a very long history of them, and in many emerging economies, actually, these things were issued in longer maturities before they could issue nominal securities. Because if you fear inflation is going to be crazy, nobody lends at you at 5 years. If I promise you to make inflation payments in addition to the normal interest payments, then I can borrow at long maturities. You don't have to know this. This is just for general culture. Okay, but let's go back to this bit. Okay, this coupon itself. Do you know how much money you're going to get on this date? Yes, very good. Notice that this 5%, this is something confusing when you are learning this for the first time. This 5% isn't the interest rate of this bond, right? The interest rate we will know when we know the price. This is the coupon rate. It's a different animal, okay? It pays 5% of the 1,000 every year, but you know, if you buy this whole thing for 900 liras, the implied total interest is one thing. If you buy it for 800 liras, it's something else. Could you buy this whole thing for more than 1,000 liras? Can the price of the coupon bond be more than the face value? I have yes, I have no. Do I have other takers? The answer, the correct answer is yes, because look, this is going to pay you over the 2 years, right? 25, 25, 25, 1,020. $1,100, right? So the 1,000, that should be clear. Yes, sure, you. I got a warning that my internet connection is unstable. Are you hearing and seeing me? Okay, are we good now? All right. Very good. Let's do this again. Now, what you are buying isn't a future 1,000, right? It's a near future 25, slightly farther future 25, slightly farther future 25, and then on maturity date, 1,025. All right? The total monetary amount you will be paid is in total 1,100 because of the coupons. Can the price of this 1,100 be more than 1,000? Of course it can. All right? You would still be getting positive nominal interest. Are we good now? Very good. Now, let me go back to my question. I asked you, this coupon or any one of these coupons, okay, do they tell you how much you will be paid on what future date? Yes, they do. But the thing that promises a fixed payment in a future date has a name. What is it? It's a fixed income and a particular fixed income. It's a bond in itself, right? I can think of this individual clippings, coupons, as little bonds. This is a bond that promises $25 on September 25th, 2020. This is a bond that promises $25 on March 25th, 2021, right? So what kind of a bond is this? This is a discount bond, right? It makes one payment only. This is a discount bond. This is a discount bond. Well, I knew how to think about discount bonds, and now I understand that coupon bonds are baskets of, collections of discount bonds, all right? And in general, this is how we price them. We ask, how much would this be worth? How much would that be worth today, right? And then add up those values and say, well, the collection has to be worth the sum of them, all right? So that's basic bond pricing for you. We could also think of separating these payments. It's called, Americans love this kind of acronyms. It's called stripping, separate trading of interest and principal. Take these interest-paying coupons, okay? Separate them and sell them. Take the principal and separate that and sell that. It can be done, all right? Again, this is just for your information. You don't really have to know this. Now, are we good with the idea of a coupon bond? Very good. Can I have a coupon bond that has infinite maturity? Can I sell you a coupon bond that never pays off its face value? All right, so we have a difference of opinion in class, which I like. Let's pick one of the people who said, calmly, that was harsh. Let's have a conversation with you. All right, are you there?
Yes, hocam.
All right, very good. You're welcome to speak, or you're welcome to write. Now, for those of you who are going to watch this later, Kaan wrote here, you can tell me that if I'm stupid, okay? And I'm going to convince him that he could be very smart and still buy this. Look, let's say I'm trying to sell you exactly this, all right? But the maturity here is infinity. So I promise to pay you 25 liras once every 6 months forever until eternity. Okay? Does this have value?
Yes.
If it has value, can I sell it?
Yes.
Let me ask you a question. Are you you knew this was coming? Are we good? Okay?
Yes.
Very good. All right. Remember to mute yourself. So it's possible to have a coupon bond with infinite maturity, and these things do exist. They are either called perpetuities, perpetual coupon payers, or consols. Right here. And they exist. They have been issued in the past, and since they have infinite maturity, people actually still get payments on this. So England issued consols during one of the interminable wars with continental Europe. They're still around, and last I looked at them, they were trying to buy them and just, the government was trying to buy them and be done with the damn things. There are little cities elsewhere in Europe that, in my opinion, and I think ex post they think so, stupidly issued bonds to make a fountain in the middle of the town square, whatever. So if you Google this, you can find this. Yale has a console from one of these, little, I think either Dutch or Belgian towns that has been paying off for several hundred years now. It pays a pittance. It pays the equivalent of whatever, €1 per year now, but they still collect it and are very proud of it. And you can see the thing. So they exist. Here's another question. Can I sell you a infinite maturity discount bond? So discount bonds, these are also known as, again, for obvious reasons, zero coupon bonds, right? If these are zero, there are no coupons. Can I sell you a zero coupon bond with infinite maturity? Okay, so the few people, very good. The few people who said, yes, I would like to sell you my infinite maturity discount bonds. Remember that a discount bond, a zero coupon bond, is one future payment. You're making a current payment for it now. And if the maturity is infinite, that one future payment will never come. And if you're saying that you would buy this, I am very happy to sell them to you. How about that? Özge Hanım, what do you think now? All right, I'll repeat. But again, think for a second, and it's going to be very clear to you. You don't need me for this, right? The idea is this. A zero coupon bond, a discount bond, is the promise for one future payment. Do we agree on that? Yes, very good. If we agree, what is the value of one future payment that will never be made because the maturity is infinite? I'm trying to sell this piece of paper to you that says, this pays 1,000 liras, never. This pays 1,000 liras, you know, when, whatever, kingdom comes, kıyamet gününde. That's infinity, okay? What is the value of that paper to you today? Would you buy this at any price? All right, yes, exactly. So this is an economist joke, right? When you want to call someone stupid, you do say, yeah, you could sell the guy a zero coupon console. All right, very good. Now let's spend a few more minutes on bonds, interest rates, and related things. One important bit is to understand the relationships between present values and future values, right? Because whenever we're saying over time relationships, we're talking about over time values. So let's have a timeline, and my timeline is not going to be a straight line because that's how I use the board, so don't laugh. But here's our timeline, okay? Here's today. Let's call this date 0, right? So here is, if this is annual, this is next year. Here is the year after, all right? Now, when we are looking within date 0, life is easy because all 1 liras are the same 1 lira, same 1 lira's worth of purchasing power. All 1 potatoes are 1 potato that I can eat today, okay? But when we begin to compare date 0 and date 1, then, well, a date 0 potato isn't exactly the same thing as a date 1 potato because tomorrow's me isn't exactly the same person as today's me. A date 1 lira isn't exactly the same thing as a date, my apologies, a date 0 1 lira isn't exactly the same thing as a date 1 lira because inflation will change the potatoes that 1 lira can buy, okay? So how do I think of, and this is the idea of present value versus future value, okay? It's at the root of, I would say, almost all of finance. In fact, if it's not all of finance, I don't know what the alternative is. So here I have present values. Here I have future values, future values. Again, it should be clear that these are different future values, right? This is the date 1 future value. This is the date 2 future value. The present value is always from today. But I could ask questions like, think in date 0 that you are in date 1 making a loan for date 2. What do you think the present value will be then? Okay, that's a very well-defined question. These are called forward rates. Türkçesi ileri valörlü. Valör, bugün karar verdiğimiz bir işlemin ne zaman gerçekleşeceğine dair bilgi. Yani şu bonoyu size satıyorum. Tamam, anlaştık. Şu fiyattan alacaksınız. Fiyat bugün ortaya çıktı. Fakat bunun valörü yarın olabilir. Ki birçok yerde öyledir. Öbür gün de olabilir. Şu demek, biz fiyata bugün karar verdik. Fakat ben bonoyu size öbür gün vereceğim. Siz de o parayı bana öbür gün vereceksiniz. İşlemin kendisi öbür gün gerçekleşecek. In a lot of countries, the technology doesn't quite allow same day, what is called settlement of these transactions. We agree on a price, we agree on a transaction. I will sell you the bond, you will give me the money. Okay? So the price is determined today, but it takes 2 days for us to do the transaction itself. The US is this way. It's called T+2 transactions, T+2 settlement. Okay? In Turkey, we actually have a better system of doing these things because we are exchange traded. So we can and do same-day settlements. Once again, you don't have to know these things. But you do have to know the idea of the present value and the future value. So what happens here is I have 1 lira, okay? And I ask, what is the future value of 1 lira, okay? What is the equivalent of 1 lira today on date 1 from the perspective of date 0? Well, the answer is, if I buy a bond for 1 lira today, what will that bond pay? Or if I lend my 1 lira today, okay, what will I get on date 1? What I will get is 1 plus I in money terms. Do we agree? Right? Okay. Now, I'm going to ask the converse question. If I'm promised 1 lira in the future, what is the equivalent of that 1 lira? What is the value of that 1 lira today? Okay? In middle school, you learned proportions. This is a proportion question. Oran orantı sorusu. If 1 lira today is worth 1 plus I tomorrow, okay, what is 1 tomorrow worth today? Very good. That's exactly right. Okay? The answer is 1 over 1 plus I. And in fact, this is how we think of bond prices. If I have a bond that pays off 1 lira, this is the future value. That's what the bond specifies. The price of the bond is 1 over 1 plus I. Okay? Very good. Let's say I is constant. The nominal interest rate is constant. Then date 2 is going to be 1 plus I squared, right? Because it's going to be multiplied by 1 plus I. It's going to be multiplied by 1 plus I again. But this is going to be multiplied by 1 plus I again. That's the idea of the compound interest, bileşik faiz. Okay? Interest also accrues interest as you roll over it, Is that good? Okay, cool. Similarly, then, 1 lira here has a present value today of 1 over 1 plus I squared. All right? Clearly, payments further into the future have lower present value. More interest has to accrue for me to agree to lend at longer maturities. All right? Good. Excellent. Can I think of the real and nominal interest rates similarly this way? Can I bring in inflation here? Sure. I won't do it, just not to clutter things, but the idea is very clear. Okay, excellent. Now, here's another thing. We think of interest rates, or we report interest rates always in annualized terms. Daima yıllık faiz diyoruz biz buna ama aslında doğrusu yıllıklandırılmış. Interest rates, when I say, okay, so Turkey borrows, this is factually correct, at about 8.5% interest for 5 years in dollar terms. That 8.5%, everyone understands, is 8.5% per year, okay? It's this. And this goes for 5 years, okay? Even with annual interest rates, annualized interest rates, as the maturity increases, usually interest rates increase. That means this. If I borrow from you for 1 year and the interest rate is, let's say, 10%, okay? Now I come to you and say, I would like to borrow from you for 10 years. At what annual interest rate would you lend me, okay? If you're lending me at 10% for 1 year per year, at what interest rate per year would you lend me for 10 years? This doesn't have a correct answer, okay? So I'm just asking for, what would you do? If you're trying to make a calculation, you can't. Okay, so let me say, I can rephrase. First, let me answer Mohammed Bey's question. It doesn't, I just said, if the future value is 1, okay? Let's say I promise you 2 years from now. What is the value of that? What is the present value of that today? Okay, that's this 1. And the present value is 1 plus I squared, all right? And the question I'm asking you is, we report all interest rates annual, okay, in annualized form. But I want you to see that they will not all be the same annualized interest rate as bond maturities change. If I want to borrow from you for 1 year, and you tell me, fine, I'll lend you at 10%, okay? If I come to you and say, I want to borrow for 10 years, at what annual interest would you lend me? In general, the answer isn't, it's still 10%, okay? Usually you say something like, well, okay, if you want to borrow at 10%, at 10 years, we will lend you at something higher than 10% annual interest, okay? That is, borrowing at 10 years on an annualized basis is more expensive than borrowing at 1 year, all right? And that relationship has a name. That relationship is called the yield curve. Türkçesi getiri eğrisi ya da verim eğrisi. Ben getiri eğrisi kullanırım. Ama siz uygun gördüğünüz gibi kullanabilirsiniz. The yield curve is the relationship between maturity. Once again, this is something you do not have to know. This really isn't 102 material, okay? But this is my research, and I would like to talk about this as I'm telling you about interest rates and bond prices and whatnot. Okay? And the idea is, here I have maturity, vade, and here I have yield, the interest rate implied by this bond, okay? For coupon bond, it's a slightly trickier thing to measure, but we know how to do that. And usually that relationship looks something like this, okay? It's upward sloping. That is, borrowing at longer maturities is more expensive than borrowing at shorter maturities. Now, again, those of you who are economists, you're gonna think deeply about these things at some point and figure out that the slope of this thing is important, because in the end, what I'm looking at is, let's say this is 1 year, okay? And let's say this is 2 years, all right? When I see that the annualized rate to borrow at 2 years is more than the rate to borrow at 1 year, I understand that, look, I could have done one of two things. I could borrow for 1 year. At the end of the year, I would borrow again for 1 more year. Or I can borrow for 2 years now, okay? And this upward slope is telling me that if I want to lock in the second year's interest now, the 1 year interest rate that we're going to agree on today to begin 1 year from now, this is a lot of 111s going on. So let me say this again. Hear me out, and if you don't understand, don't worry about it, okay? This is really for the fun of it. And you can come to my online office hours and talk about this if you want to. I'm going to borrow at 2 years. So I can come to you with two proposals, and they should have the same implied future payments. One is to say, why don't you lend me at 1 year and sign a contract that promises to lend me for 1 year, beginning 1 year from now, so that it covers the entire 2 years, okay? And we're going to set the interest rate for that too, right now, okay? That thing is called the 1 year forward, 1 year interest rate. Tam Türkçesi ileri valörlü işte bu. İleride başlayacak bir borç alacak ilişkisi için şimdiden faiz belirliyoruz. 1 yıl borçlanayım, 1 yıl sonra 1 yıl daha bana borç vermek için şimdiden bir kontrat imzalayalım. O kontratta da 1 yıl sonraki 1 yıllık faizin ne olacağını da yazmış olalım. Tamam? Or I could come to you and say, why don't you lend me at 2 years? And at what interest would you lend me at 2 years? Okay? In the end, you can write down and see that these two have exactly the same coverage. We are agreeing on a debt contract that covers 2 years, and we are agreeing for that today. So the two ways of funding me must have the same implication. That essentially means by looking at the 1 year interest rate and the 2 year interest rate, I can back out the implied 1 year forward, 1 year interest rate. This is something very close to, but not quite, the expected 1 year interest rate 1 year from now. Okay? And that question is important for me as an academic or as a central banker, because I do want to know, what do you think the short-term interest rate, the 1 year interest rate be in the future? All right? Here's why I care about this. If you think that things are going to go well, but let's say if you think that there is going to be inflation, okay, and you think that inflation is going to go up, and to fight inflation, the central bank will raise interest rates in the future, then longer-term interest rates will be higher than shorter-term interest rates. We're going to see something like this, okay? But if you think that there's going to be a recession, things will be bad, okay? Inflation will be low, output will be low, unemployment will be high, and the central bank will lower interest rates to prod you into demanding more. And you're going to see the mechanism of this with Burçin Hoca, okay? Then you will think that, well, things are kind of okay now, but next year, I think, will be a shitty year. And therefore, I think that interest rates will be lowered next year. Then the 2 year rate will be below the 1 year rate, okay? And I'm going to see the yield curve looking like this, okay? This is called an inverted yield curve, and central bankers fear this because they think that the inverted yield curve is the way markets signal expected recession. And that's why, as academics, we are interested in thinking about these things. What exactly is being priced in here, how I think about inverted yield curves, whatnot, okay? The last bit of this lecture, where I talked about the yield curves, is way above your knowledge of economics and way above, you know, what is normally taught in 1 or 2 classes. And in fact, it's not formal course material. It's only for your information so that you would have some passing affinity with these concepts, and hopefully you will be curious to learn more about them. Now, we're going to take a 5 minutes break. I'm going to pause this recording, and 1:45 noon, I will start lecturing again, all right? Meanwhile, go grab a cup of tea or do whatever you want to do. I will see you in 5 minutes. Take care. We are back. The next order of business is to talk about basic central banking, right? So we talked about money, we talked about bonds, right? And now we're going to talk about, fine, let's say you're the central bank and you are the sole authority in this country of issuing banknotes. And you decided that, fine, I would like to change money supply now. I would like to have more money in circulation. The first thing for you to do is to create more money. And depending on how you do things, you can print it, or if these are electronic entries, you can just, press a button and create it, or whatever. But once it's created, once this money is in existence, it's in existence at the central bank. It's not circulating yet. So the question then is, how do we get money into circulation? First, let me ask, do you understand the question here, right? The central bank is, in a sense, the producer of money. So it creates money, and let's say I'm the central banker, right? I use the printing press, and created all this money. And you might have seen this in at the end of the news, where when they are going to talk about the economics, every now and then you see these people looking at sheets of paper money, right? Running their hands over it, turning over the page, running their hands over it. These are people working at the central bank, checking the newly printed money to make sure that it's correctly made money. Now, I printed the money. I cut those sheets. They actually look like stacks of money, and they are right here next to me. And what I want is to supply more money. I want more money in the circulation. The question is, how do I do that? All right. So one thing I could do is, I could go out on Ulus, or wherever the central bank is in existence now. As you know, our central bank is in very sad shape. Half of it has been banished to Istanbul in some dinky building in Ümraniye. A lot of it is in Ankara, and they don't know what they are doing. They don't know where they are doing it either. Well, let's say I go out in Ulus in front of the central bank and begin to hand out cash to all passers-by. Would this work? Any other takers? So I have yes, I have no. Why does it not work? If I go out in front of the central bank and begin to hand out cash, isn't there more cash in circulation? Aren't these people having more cash? Okay, so some of you are saying this is inefficient. Efficiency is a very sacred word for economists. And so don't use inefficient in this loose form, okay? Inefficiency requires you to have an efficient equilibrium or an efficient allocation in mind. And in this case, I don't think you have the information to talk about efficiency, right? Because all I told you was I wanted to get money into circulation. Did I get money into circulation? Yes. What are you complaining about? All I wanted was to get money into circulation. Is that money in the pockets of private people and enterprises, firms now? It actually does work this way, okay? It poses, I would say, 3 problems. One, if it's known that I do this every now and then, there are going to be hordes of people in front of the central bank hoping that I'm going to show up today and give money and I'm going to be mobbed the moment I step out. The second is, why am I giving it to these people and not to those people? The third, very importantly, is what do I do if I want to do the reverse? What if I want to reduce the money supply? Do I go out and hit people at the head with a plank, take their money and reduce money supply? Is that the way to do it? Because once I've given you the money, how do I get it back if I want to? So this method isn't clearly the central banker's preferred method of doing things, but it has a name. It's called the helicopter drop of money. This was Milton Friedman's famous thought experiment. What happens if a central banker prints, bags of money, gets up in a helicopter and just dumps it so that people, see this, money raining and end up having more money? What are the economic consequences of this? Maybe ever want to do this, all right? And that idea is surprisingly relevant now because a form of that is going to happen in a lot of countries very soon. Because of the coronavirus pandemic, a lot of governments will have to borrow like crazy and take over private debts, and central banks will have to fund this. That means central banks will have to print money and give it to the government. Give it to the government in return for effectively nothing. This is called monetizing the debt, printing money to make the debt payments, and it increases the money supply, okay, in ways that are very difficult to reverse. You immediately saw that. Some of these comments are along those lines, right? How do I decrease it? In normal times, what I would go out and do is I would buy something from you and give you the newly printed money. And when the time comes that I want to reduce the money supply, I will sell it back and take the money back, okay? Would that work? Yeah, and you see that it would work. And the question then becomes, what is it that I'm gonna buy and sell, right? So one idea is, I don't know, hamsi, right? I could buy fish. And the problem is, fish doesn't keep well. So if I ever want to reduce the money supply, probably, let's say after 2 years, the thing that I bought are not going to work all that well as items for sale. I could buy, so it has to be that I'm buying something that is not going to make you complain, because I could buy durables, right? I could buy, I don't know, refrigerators and sell them next year. But then the washing machine makers are going to say, why are you buying the refrigerators? Because I'm increasing the demand for refrigerators. It's good for the refrigerator makers and not washing machine makers. Okay, why this particular good and not that? I could buy equities, hisse senetleri. But then why buy the equities of these firms and not those firms? Or why buy the equities of the firms that have issued equities? Those are only the larger firms. What is wrong with the smaller firms? Okay, so in the end, the obvious solution, which many of you saw, is for me to buy government bonds. Because nobody's going to complain when the central bank, as a government institution, buys government's debt obligations, government bonds, okay? So here's what I do. If I want to increase money supply, and I used to teach this as, you should know this, because this is how things used to be done way back when, and this is the standard framework that people think, but this is not what we really do now. But oddly, we're doing a lot of this again these days, okay? The central bank does what is called, and this you should know, an open market operation. Türkçesi açık piyasa işlemi. Bu işlerle ilgilenen insanlar arasında apilemek diye geçer. Merkez Bankası apiyle şöyle yaptı, Merkez Bankası apiledi vesaire. Sabahları Merkez Bankası bir açık piyasa işlemi yapıp piyasaya para veriyor, para piyasasına, ya da buradan para çekiyor. What I want you to hear is this is something that is still being done, okay? But this is not the primary way monetary policy actually works anymore, in the following sense. In an open market operation, a central bank that wants to increase money supply goes to the money market and says, if I want to increase money supply, do I want to buy bonds or sell bonds? That's right. I will buy bonds and give money in return, okay? So it says, I'm gonna buy bonds. So it does an auction, it buys bonds and gives money. The money supply now has increased. Notice what happens though. If I come in and say, I'm gonna buy so many billions of liras worth of bonds, okay? What happens to the bond prices? All right, so I have a surprising number of decrease falls here and a much better number of increase, but a bond is a good, in a sense, it's a financial security. If I come in and I demand a lot of these things, what happens to the price of the bond? Yeah, do you all see this? Very good, right? Prices will increase, the price will go up. If the bond price goes up, what happens to the interest rate? That's exactly right. By increasing the money supply, I lower the interest rates, okay? And this is how we conceptually used to think, and in fact, how central bankers actually did monetary policy. I'm going to increase money supply. To increase money supply, I'm going to buy bonds, and this works right in both ways. In the one sense, there is more money. If you want to borrow money, there is more of it. So it's going to cost less to borrow. Therefore, interest rates are going to be lower. Or, since I'm buying bonds, bond prices will go up. Higher bond prices, given the fixed income, imply lower interest rates. Well, it's the same interest rate. Okay? Good. So increasing money supply would decrease interest rates. Right? Now, the reason why I keep on saying this is conceptually used to be the way we used to think about whatever is you have not seen in any normal time a central bank coming out and saying blah, blah, blah, and therefore we decided to increase the money supply, right? The central bank comes out and says, we decided to decrease the interest rate. This will be the interest rate. The instrument of monetary policy is no longer the money supply itself. It's directly the interest rate. Okay? The problem with this, and this is something that I really want you to know, is central banks control one interest rate. The interest rate of the shortest maturity in the interbank market. We talked about the interbank market before the break, right? Some banks are going to have too much liquidity, too much reserves. Some banks are going to have too little. They're going to transact with each other. They're going to lend and borrow, okay? And that lending and borrowing will have an interest rate. The central bank enters that market and says, I want the interest rate in that market. Depends on the country. In our country, the central bank says, I will target the 1 week rate. In the US, the Federal Reserve says, I will target the overnight rate, okay? It's different interest rates in different places, but it's always short-term interest rates. But you get to target that one, okay? Remember the yield curve that we talked about at the end of, I will say the last lecture, right? Whatever, 20 minutes ago. And understand that we never see that shortest interest rate as private people, private firms. We are not part of the interbank market, and we don't borrow overnight anyway, right? You know, you never go to the bank and say, oh, I'm going to buy a car, so I need a loan for 3 days, okay? For you, the maturity is 6 months, a year more. So by changing this shortest interest rate, the central bank is trying to affect longer-term interest rates. This idea is really important for you. In 102, we're going to pretend as if there is only one interest rate, the same interest rate for all maturities, okay? That is clearly incorrect. And in particular, if you push your central bank to lower the policy rate, the shortest rate artificially, like we do in Turkey, you may, and you do again in Turkey, end up with not lower, but higher longer-term interest rates. It's a very clean example of shooting yourself in the foot, and we are very good at that, sadly. But back to the open market operation. The central bank, Murat Bey, good question, is monetizing things suitable for Turkey. I put a YouTube video exactly on this topic, I think 2 nights before. You can find that. I discussed this, and I agree with you. In Turkey, this would not work for precisely the reason that you have brought up here, that we have a lot of dollar debt, and printing more liras is going to make the lira cheaper. We haven't talked about exchange rates, but you have got it, obviously. So I don't think this is appropriate for us. But for the US, it works because they are going to be monetizing dollar debt by printing dollars. In England, it's going to work because they're going to monetize pound debt by printing the pound, the sterling. All right? Bonds the central bank buys are bonds like any other bond. So if they mature while being held by the central bank, the treasury makes a payment to the central bank. Since that main payment means money is moving from the treasury to the central bank, it lowers the money supply. And if the central bank doesn't want this, it would have to buy other bonds in return so that it's going to get that money out into the money market again? All right, good question. What if the government doesn't pay these bonds? The government, the treasury, doesn't know which exact bonds are held by the central bank. When you're defaulting, you cannot default by holder. Okay? You have to say, I can't make these payments, whoever is holding them, right? And if you wanted to selectively default and say, I'm going to only default to the bonds held by the central bank, then the central bank, not being stupid, will sell those bonds the day before they come due to you. You are not the central bank. You will be paid, and the central bank is going to buy longer maturity bonds. How about that? All right. Selective default doesn't work. Cool. Are we good with the open market operation? The central bank buying and selling bonds, changing bond prices and interest rates, and money supply in the process. Are we good there? Very good. And thank you for your responsiveness. I really appreciate seeing all this chat moving here so that it feels like we are doing class and I am able to somewhat keep an eye on you in terms of whether you're getting it, whether you are nodding, or whether you are dozing off. So I really appreciate this. Okay, now, the money, the physical money that the central bank creates, the money that is created by the first time by the central bank and given to banks. I know these are banks because in almost all countries, including Turkey, there are what are called primary dealers. You don't have to know this language. Primary dealers are the counterparts to the central bank in the open market operation. So when the central bank says, I'm going to buy bonds, you know, I can't say, oh, I have a bond, I want to sell this to you, okay? It's only the banks, and usually only some of the banks, that can enter this auction, right? Those are called primary dealers, but in the end, central banks do business with banks. This is again for normal times. Now around the world, we're seeing central banks doing business with anyone you can imagine because liquidity is madly needed by everyone. Now, the central bank takes bonds from banks and gives them cash, okay? Cash at banks is, you will remember, reserves that can be used to cover reserve requirements, right? Because we said banks are going to have assets and liabilities and capital, right? And they're going to use this capital and also deposits and perhaps other loans, right? Non-deposit loans. These are usually called non-core liabilities to fund essentially, once again, loans. These are the loans the central bank, no, I apologize. These are the loans the bank makes. So the bank uses its capital, uses the deposits unit, uses the loans it gets from, let's say, international banks to make loans here, okay? And it has to hold reserves. In some countries, the required reserves are zero. The regulator does not force the banks to hold liquid reserves, but the banks, because they're not stupid, they hold it anyway. And that's exactly why the regulator doesn't force them to do so. In our country and in most countries, these are required reserves. You have to hold, let's say, 6% of deposits as reserves. Okay? Türkçesinin eski diliyle munzam karşılık, yeni diliyle zorunlu karşılık olduğunu biliyorsunuz. We spent a lot of time talking about the bank balance sheets and the reserve requirement ratio and the capital adequacy ratio and whatnot. But notice that now we understand there's one more thing here, right? These banks also hold bonds. They do hold treasury bonds. And when the central bank comes and says, okay, sell me the bonds and get reserves in return, right? They have more reserves. That means they can issue more deposits. Okay? This is something important. Now, there are several ways of thinking of this mechanism, but in the end, the following is correct. The amount of money the central bank has created and given the amount of reserves puts a limit on the amount of deposits. The banking sector as a whole has to have reserves to have deposits because of the reserve requirement. Thus, if the central bank is reducing the money supply, if the central bank is saying, okay, I'm going to sell you bonds, right? Well, the banks are using their cash to buy the bonds. There is less cash now. The coverage has fallen, so they will have to tell someone, I don't want your deposits anymore. The way the banks say this is usually by lowering the interest rate. Right? Don't bring me your deposits. Okay? By increasing the spread between the rate at which they lend and the rate that pay on deposits. Banks actually have many ways of telling you, I don't want your money, okay? Or I can't have your money. But do understand, lowering the amount of reserves has to lower the amount of deposits, all right? We think of money, and we talked about money and liquidity in detail in the past. So now we want to ask, what exactly is money? When I want to count the money around, okay, what is it that I count? One thing, an obvious thing, is how much money has the central bank created, okay? That thing is called high-powered money, and you're going to see why it's called high-powered in a minute. Or the monetary base, okay, or base money. It's the same thing. But then, if you ask me how much money I have, I could tell you how much money I have in my wallet. I could also tell you how much money I have in the bank. And of course, from my perspective, as long as I have demand deposits, vadesiz mevduat, by definition, I can have access to them whenever I want. Demand deposits are almost perfect substitutes for physical money. Would you agree to this? Any other takers to whether you agree or not? If I have money in the bank, in demand deposits, vadesiz mevduat, okay? Is it essentially the same thing for me as having money in my wallet? Okay, yeah, you get it. But if it is, then the total amount of money around isn't just the physical money, the high-powered money. It's base money plus demand deposits, okay? So we call that, this goes to the Friedman Samuelsons of the world. They thought about these things and said, okay, we're going to call this M1, okay? Monetary aggregate, parasal büyüklük, monetary aggregate. M1 is base plus demand deposits, okay? But then I think that I also have time deposits, vadeli mevduat. They are slightly less liquid because these are interest-bearing or higher interest-bearing, and I have to sacrifice the interest to withdraw this before maturity. But if I have a time deposit at a bank, could I go to the bank and say, I don't want to wait until the maturity. I want my money back now. Is this possible? Yes, it is. If it is possible, then can I convert my time deposit into money immediately? So the same person saying, you can get your money out, yes, but you can't convert it to money immediately. No, I don't understand how you can have the yes and no simultaneously. Do we agree that I could go to a bank and say, I'm going to give up the interest, give the money in my time deposit now. Vadeyi beklemeyeceğim, bu hesabı kıracağım. Bana şimdi hesaptaki paramı verin diyebiliyor muyum? Tamam, Türkçesiyle bu. Can I do that? Yes. If I can do that, can I treat the money in a time deposit as money? Yes, okay, now we're good, all right? Thus we have M2, which is M1 plus time deposits. If you go to the central bank webpage, you can see the definition of these things, and you're going to see that there are other, smaller items in there, but this is the general sense of it, all right? And this usually is what we treat as money. This is usually our preferred measure of money, okay? When we say how much money in this country, what is happening to the amount of money around, whatever, we're usually tracking M2. But do understand the following. The central bank creates the high-powered money. The high-powered money enters the banking system, turns into deposits, time deposits, whatever, and then turns into M2, okay? And we're going to talk about how this happens in a minute. But it is the inclusion of the banking system that takes the central bank money and turns it into M2, all right? And that process doesn't work as well at all times, at all places. First, let's understand how this works. Let me tell you the story, then I will also illustrate this by drawing and writing. I was a bank. The central bank came to me and said, I want to buy your bond. I sold my bond, I got reserves, okay? I looked at this and said, I don't want this much reserves, okay? Because I'm holding more cash than is required by my deposits and than is required by how much I wanted to do. How do I know that? Well, before the bank sold the bond, it was happy having this amount of reserves. Once it sold the bond, it now has that much reserves. Clearly, it has more than once, okay? What is it going to do? It's going to do one of two things. Either it's going to say, well, I'm going to issue more deposits now. I'm going to increase the deposits. Fine, right? But then you're going to look at this and say, I still have too much reserves, right? Because I have all these deposits, I have all these reserves, but why would I want to do this? Why would I issue deposits, collect more deposits, just to have more reserves, okay? I'm going to give more loans. That's the whole point. More reserves are going to turn into more loans, all right? So somebody is going to get a bank loan, but notice what is happening. When I'm looking, I see that the central bank has created more money, right? So I see that physical money, base money, has increased. This money turned into a loan to someone. Not all of it, but probably most of it. The person who has taken the loan, when I ask her, how much money do you have? She's going to look into her wallet and say, oh, I have this much. It is the same money, but I see this as base money. The bank sees it as money there. And the person who borrowed it also sees it as money, okay? Then that person is going to buy whatever she borrowed, right? She was going to buy a new sports car. She bought the car. The car dealer now has all this cash, right? What is the car dealer going to do with that? Put it in the bank. It's going to turn into a bank deposit, okay? The bank is going to say, oh, I have more deposits now. I have to hold some of this as reserves, fine, but the rest I'm going to give out as loans. Notice that this process goes on, okay? This is called the money multiplier, and that's exactly why this is called the high-powered money. If you give one more lira in bank reserves to the banking system is going to take that and turn it into loans. Loans are going to become deposits. Deposits are going to become more loans. And therefore, in this total, when I'm looking at what is the total of base money, demand deposits, and time deposits, okay, the increase is going to be much larger than the initial increase in the high-powered money. The ratio I'm going to call the money multiplier. How much M2 does one more lira of high-powered money, one more lira of central bank money create, okay? That is now a problem because at times when it's all uncertain, nobody knows who is solvent, who is bankrupt, nobody knows how much liquidity they're going to need, everybody tries to hoard cash, okay? So when the central bank tells these banks, okay, I'm going to give you more reserves, the banks say, thank you. We were really worried that we might need more reserves. So we're going to take these reserves and we are not going to turn them into loans. We're just going to sit on them. On the other side, you have these other firms that are saying, I have this bond that is maturing. I need to borrow again to pay this off. I am a solvent but illiquid firm. I should be able to borrow, okay? And people having a liquidity all say, yes, but liquidity is too valuable these days, so we don't want to lend, period. What happens? On the one side, you see the central bank dumping reserves and lowering interest rates, okay? So last weekend, the Fed, this is the Sunday before, the US central bank said, we're lowering the interest rate to essentially zero, okay? And we're going to dump a ton of liquidity on the banking system, right? But what we saw was the prices of private firms' bonds kept on falling. Their interest rates went up, didn't go down, okay? Why? Because that money wasn't being directed to these banks, these firms' bonds. Their interest rates went up, okay? So the Fed finally said, okay, we're gonna buy directly those bonds too, non-government bonds. We will buy, for example, commercial paper. Commercial paper is very short maturity, private sector bonds, okay? The US central bank is now directly buying these things. The time deposit is a deposit. This is, I apologize. I said what it is in Turkish, but I did not explain what it is in English. A time deposit is a deposit where it promises you a interest. Demand deposits usually don't, but you have to hold your deposit there for a certain amount of time. So you say, okay, I'm going to put this money here into your bank, and I will not withdraw it for a year. And at the end of the year, you will pay me interest, okay? After 3 months, you can go and say, I decided to withdraw it. If you do so, then you forfeit the interest. That is, you no longer get the interest that you were due, but you can get it. Sometimes the bank says, if you want to do this, you have to let me know a week in advance, something like that, okay? There are different ways of structuring this, but that is what a time deposit is. It's a deposit with a maturity, okay? Now, let's talk about this money multiplier thing again, right? Because I do want you to see, when the central bank, for example, drains reserves from the system, okay? Less reserves, right? The bank either has to say, I don't want your deposit, okay? Or somehow get more reserves, but either way, if it has less deposits or it has to convert loans directly, it has to have less loans, right? The moment I take out reserves from the banking system, I force the banking system to be smaller because deposits can be a multiple of reserves because of the reserve requirement, right? If I tell you that you have to have cash reserves that is equal to, say, 5% of your deposits, and then I enter the market and reduce the amount of cash in the market, in the interbank market, right? Then it has to be that the amount of deposits will go down too. The banking sector as a whole will have to shrink, right? Banks have a lot of ways around this to make sure that they don't have to do this. So for example, they can substitute loans for deposits. They can turn deposits into sweep accounts where whatever. There are ways in Turkey, there are ways in the US, and central banks have ways of hitting the banks with a heavy stick so that they are doing what they want them to do, right? When you take a course in monetary economics, for example, you will learn a lot more about these things too. Now, for our 102 purposes, the thinking is, let's say the central bank comes in, sells bonds, reduces the money supply, all right? There are less reserves in the banking system now. Loans will go down. Deposits will go down, okay? But the chain now works in the other direction because you wanted to borrow again, and I said no. and you said, damn it, but you couldn't borrow again, okay? But you had your payment to make, you made your payment, okay? Cash went back to the bank, and that cash is now sitting at the bank, not being lent out, okay? The money multiplier this time works in the opposite direction because deposits have to go down. When deposits go down, loans go down. When loans go down, other deposits will go down, right? The total contraction in M2, the monetary aggregate, is going to be larger than the contraction of the monetary base, okay? Let me ask you, are you okay with this idea of the money multiplier process and the money multiplier itself? Okay. You'll have a homework. Well, you will have to work this out, all right? But it works more or less, not more or less, but in a simple world, it works in the following way. I say the reserve requirement is RR, okay? This is something in percent. So I give, as a central bank, 1, right? The first bank then gives a loan of 1 minus R, okay? This turns into a deposit. The next bank can give a loan of 1 minus RR times 1 minus RR, right? It depends on how you want to count these things. You could say this bank gets 1, okay? Since it has 1 more reserves, it loans out the 1 as a whole, so that's 1. Then a bank gets that 1 as deposits. It can lend out 1 minus RR, right? 1 minus the reserve requirement. Then somebody gets 1 minus the reserve requirement here as a deposit because you don't leave money lying around. It goes back to the banking system, okay? This is the idea we have now. We could think of what happens if people keep some of the money in their pockets, okay? But for the moment, we think if you have money, you always have money in the bank. So a bank gets a deposit of 1 minus the reserve requirement. Of this amount, it can lend out 1 minus the reserve requirement, right? And this is going to go on. So, you know, it's going to be 1 minus RR squared times 1 minus RR, whatever. The total increase is going to be the sum of this. Do you see that? Yes, okay, so we're good. Thus, that sum, okay, since it is 5, 1 minus R, okay? And this animal in the model that we just talked about, this in the setting that we just described is the money multiplier. Okay? It is like a chain reaction. The multiplier reaction is always like a chain reaction, exactly. All right? Now, in your homework, I will ask you to think about a world where there is a reserve requirement, but also people have a preference for cash. So whenever you get a bank loan, and whenever it is out in the private pockets, not all of it returns to the banks. So let's say you hold 3% of the cash you get in your wallet and deposit the rest. What happens to the money multiplier then? And you can work that out. RR is reserve requirement, yes. Okay? Very good. All right. This is more or less it in terms of what I wanted to tell you about the mechanics of the central bank changing the money supply and how that works. And in terms of bond prices, and in terms of thinking about the bond market, and in terms of thinking about the relationship between money and bonds and monetary policy, okay? Do recall that central banks have various purposes, various duties. And in different countries, they do different things. But in all countries, they do this. They are the sole authority of changing the money supply, okay? In all countries, in the end, even if they are not legally so, practically they are the lender of last resort. because the institution that can create liquidity is always the institution when things are bad enough that people turn to for liquidity, okay? So in our country, we actually have 3 bank regulators, right? We have the BRSA, the bank regulator, that is in Turkish BDDK, Bankacılık Düzenleme Denetleme Kurumu. The Banking Regulation and Supervision Agency, okay? We have the TMSF, Tasarruf Mevduat Sigorta Fonu, the FDIC equivalent in the US, which is the Deposit Insurance Fund, okay? Understand that one of these things, the BRSA, the bank regulator, is in charge as long as the bank is doing all right. For a solvent, ongoing enterprise bank, BRSA is looking over his shoulder, making sure that one hopes, right? You know, is holding the right amount of reserves, it's not stupidly lending, it's not doing, you know, illegal stuff, it's not doing stupid stuff, okay? But if a bank goes under, if a bank goes bankrupt, then the deposit fund comes into play and says, okay, I have the deposit fund, I have insured the depositors of this bank up to a limit, and now it's my job to make sure that this bank is wound down correctly, its assets are sold, people are paid off, whatever, okay? And the central bank is there all the time saying, okay, I don't want to see banks going bankrupt because of illiquidity, because by definition, all banks are illiquid. But if you have things of value, you should not go bankrupt, all right? In particular, central banks have what are called discount windows. And now you know the word from the discount bond, iskonto, okay? Where they allow banks to come to the central bank and say, you know, look, I have these government bonds, okay? Let me pledge these as collateral, teminat. Let me give these to you, and I want you to lend it to me, okay? Now, this is okay from the central bank's perspective, because the central bank is getting collateral. It's not a naked loan, okay? The bank is saying, I have something of value. How do you know? Because I'm giving it to you so that you give me cash now, all right? This happens. This is the discount window. In different countries, there are different customs of running this. In most countries, the discount rate the central bank charges, the rate of borrowing from the central bank, is higher than the policy rate. That is, the central bank says, I will put in cash into this market, the money market, or withdraw cash from the money market to make sure that the interest rate here is at my target. That is the target that you hear when the central bank announces policy, right? The central bank says, we decided that the policy rate is going to be 10%, okay? It means I will inject or remove liquidity from the interbank market such that the interbank market 1 week rate is going to be 10%, okay? In our case, it means I will allow up to a limit the banks to do repo operations with me. We talked about the repo before. If you don't remember, that's all right. At this interest rate, okay? But they let the money market operate on its own. The banks lend and borrow, okay? But let's say at the end of the day, you are a bank that is not able to borrow. You need liquidity, and you can't borrow from the interbank market. What do? Okay? You go to the central bank and say, I would like to borrow from you, all right? And the central bank says, if you can pledge collateral, if you can show me that you have government bonds of sufficient value, and usually that value is higher than the loan that I'm making you, okay? Then I will give you this loan, all right? That is the central bank being the lender of last resort. And by changing that discount window rate, you could incentivize the banks to borrow more from you or borrow less from you, all right? That's one other way of changing the monetary conditions. Or you can change the reserve requirement. You could say, you know what? You used to have to hold 3% of your deposits as reserves. Now you have to hold 5% of your deposits as reserves. The immediate effect is shrinking the money market, right? Because you can see that the money multiplier is smaller now, I haven't changed the amount of high-powered money, but I made the multiplier smaller. The same amount of central bank money now funds a smaller amount of deposits. So deposits and loans will have to go down, okay? Central banks can, and every now and then actually do use all of these as tools of monetary policy, all right? So next week, you're gonna start with Gürkaynak Hoca, thinking and talking about how exactly these things work, how money supply and money demand interact. We haven't talked about money demand at all, and how the equilibrium in the money market is formed, and how the central bank can use this to do monetary policy, okay? Now, unfortunately, you haven't met Gürkaynak Hoca before this semester, because we had divided the semester almost evenly. First half is mostly me, second half is him, okay? I will be back for a couple more lectures at some point. But I am very sorry that you will be doing class with him, not having met him in person at all. So let me tell you that Gürkaynak Hoca is truly wonderful. He's a great economist, like me, and like you will be. He is a product of Bilkent Economics. And we were very lucky that after his PhD, we were able to hire him back. He and I have been teaching 102 together for a while now, and you will recognize very quickly that he is the competent teacher between the two of us. So although you will not get to see him immediately, you will get to know him. And I do ask that start out being vocal in his class too. Chime in from chat so that, like me, he also understands that he is teaching to people who are interested, who are involved, all right? Please do take this seriously. And we will be in touch. I will continue to hold my regular office hours. You're more than welcome to join in, and I will send you an email with a link again. But that is it for a few weeks, and we'll be back together. Until then, be well, stay at home. Make sure that you are doing your studies in a timely manner. If you get used to the habit of watching the videos afterwards, you'll be lost within a week. But I do enjoy this. I do thank you very much for being here. And take care, be well. Goodbye.